Good morning in Germany and Europe, and good afternoon in China and Asia. Very happy to have you here with us to our first webinar of the Sino-German Center at Frankfurt School of Finance and Management. A special warm welcome to our two speakers, Julia Haes from the China Institut der Deutschen Wirtschaft and Xiong from the Deutsche Bank China. As you know, our topic today is about the outlook for the Chinese economy in the year of the horse, more precisely the fire horse, also 2026. The fire horse, a very special animal, by the way. Maybe you check this in the internet. So it could become a special year, perhaps also in terms of economic development. Before I hand over, maybe a short note on the results, economic results 2025. As you know, we have an official growth rate of 5%. Whether this holds is another story. Some other research institutes have a lower one, but even if we have the lower one, it's still much higher than in Europe and even in the United States. Growth drivers obviously have been the net exports, that means the trade surplus. There is no doubt about that. Whether this can be continued in 2026 is another story, seeing, for example, the discussion on the exchange rate policy of China. Consumption was weak again, rather weak, somehow at least in 2025. And one of the issues behind is that the real estate crisis seems to be still not over. So we have what we call in economic terms called a wealth effect. That means if people get poorer in terms of their stocks, then in terms of their wealth, and they're also more cautious with consumption. And investment was at best mediocre. This is the overall situation, more or less, at least from my point. Maybe the speakers have other perception on the last year. Having said that, I hand over now to Dr. Xiong he's the chief economist of the Deutsche Bank, and he has a degree, a PhD degree, as well as a master degree from Peking University. For the procedure, as you know, we, after the introductory statements, which will be recorded, we have a Q&A session that will be not recorded. So feel free to type in your question. I will hand forward them to our two speakers. So having said that, let's start. So Dr. E, the floor is yours. Please go ahead.
Thank you very much, Professor. Thanks for inviting me again to this annual discussion on China's economy. I do have some slides to share, so let me share my screen from here on. I hope you can see here. Yes, so the Chinese economy had another year of 5% growth in 2025, and it's now 5% growth in a row. The economy was growing faster in the first half of the year, and it was slowing down a bit towards the second half of the year for the reason, as you have mentioned, that consumption slowed down a bit, and also the government spending slowed down a bit towards the last few months. Once the government recognized that the 5% growth target is within reach, but also because they did accelerate spending initially in the beginning of the year. For 2026, our forecast right now is for 4.5% growth, so a 0.5 percentage point slowdown from 2025. And the main reason for this forecast is the fact that indeed Chinese economy has been relying quite a lot on external demand in the past 2 years. 2025, at the beginning of the year, we thought because of trade war risks and everything, the contribution of external demand would come down a bit. It didn't come down much. But for this year, I think it's going to be very difficult for the Chinese economy in 3 years in a row to rely on external demand to continue to be a big driver of growth. So, and also the trade surplus has reached a record high last year. I think it's going to be difficult for this to keep on growing. So we do have slower growth, mostly owing to this external demand story. Another thing also will be contributing to China's growth is the policy called anti-involution. I think some of you might have heard of this word, others not. But in the Chinese policy setting, this word is quite new, and it actually refers to the status of excessive competition among companies that lead to erosion of profit, cutting prices, and in the end, it's a competition that yields benefit for no one. So what the government is trying to do is to prevent this kind of excess competition. And the situation they adopted this policy is quite similar to what happened in China 10 years ago. And back then, there was a big round of policy called supply side reform. And the goal is similar, basically to tackle the issue of sustained drop in producer prices and also the situation of low capacity utilization, meaning excess capacity in certain industry. But the word has changed also because the meaning of this policy has also changed somewhat, although the macro setting looks similar. In terms of goal, definitely achieving stabilization in prices is one of them. But I will use one sector as an example, and I think it's a sector quite would be of the interest for our audience, especially in Germany. That's the automobile sector. If you look at what happened to China's whole auto sector in the past 5 years, there's been constant price war, especially since 2023 or so. If you look at these companies' performance, their profit margins have been coming down 5 years in a row. But at the same time, if you look at the demand side, their car sales is actually increasing every year over the past 5 years. So this is not a typical situation of industry going into contraction in demand and leading into excess supply and the price cut, that kind of story. This is really in a growing market. You see these companies compete too much with each other on prices fronts and other fronts. And I think the main explanation for that is what you can see on the right-hand side of this figure I'm showing here. That is, with the revolution of EVs entering the market, you also see a lot of Chinese new companies entering into the auto sector, and that has led to a sharp decline of market concentration ratio. That, for example, the top car maker in China used to own 25% market share back in 2015 or so, and that's similar to, for example, the market share of top automaker in Europe, in Japan, in all the major markets. But as of today, the top Chinese car maker own only 15% of the market share because of the competition. So as you can imagine, with this kind of dynamic market concentration and the competition landscape, but that naturally leads a lot of competition. So really what the government needs to do is that try to foster this competitive landscape to a more stable situation where the market concentration need to increase, and also the car makers need to move from a stage of today competing for market share to a stage where they're more comfortable where they're positioned in the industry. And I think that's probably the longer term goal of this whole anti-involution policy, that you need to avoid excess competition and to have that happen, have a more stable market dynamic. Going to be crucial. But I think this is a process that will take time. These are very huge, huge companies, and you need to. It probably will take a long time for mergers and acquisitions or market clearance to happen. But we're glad to see that this has become a policy goal of the government. More broadly speaking, despite this economy staying at 5%, slowing down a bit in the second half, we're seeing some positive development on the prices front. I think for a long time, the deflationary prices has been a big challenge for the Chinese economy, and we are finally seeing some green shoot of improvement there. That China's core consumer price inflation, for example, has been steadily increasing for about 3 or 4 quarters now. It's now at around 1%, and also headline inflation also started to rebound with some rebound in food prices we're seeing lately. So I think it's good to see that progress is being made on the reflation front, although it's still far from where we want to be. The government has the inflation target of 2%. We're still only at just around 1%. So there's only halfway achieved, and we still have more to go. And I hope we can keep on seeing progress being made on reflating the economy. And this will require both supply side measures such as anti-involution policy to reduce capacity, reduce price, excessive price competition, increase market concentration, and also it will also require progress on the demand side. And we're seeing the government has been emphasizing still on encouraging consumption. And for this year, there is a shift towards the services sector consumption. So I think that's an interesting shift. In the past 2 decades or even longer, when we talk about Chinese government want to stimulate consumption spending, they usually only focus on the consumer goods such as home appliances, cars, cell phones. Really, this is the first time, I think, for a long time, we're seeing they're emphasizing that also people have more scope to spend on general services such as leisure, travel, even elderly care. I think this shift is actually quite important because if you look at Chinese consumers, this is really where there's higher potential for them to spend more. Now, we need to come back to the topic of property sector. This has been a lingering issue with Chinese economy for the past 4 or 5 years. And I don't think I have a lot of good news to report here in the sense that I think last year when we had a discussion, I was hoping that we're finally reaching a bottom of the property sector and things will start to improve from here. However, what we saw in the past year is that prices continue to decline a bit at a lower pace, but also at the same time, we see another drop of new home sales. So on both volume and price front, we're not yet at the bottom of the housing sector yet. I think it's going to be quite difficult to predict what will happen next, but at least the momentum we're seeing on the ground as of today is for maybe this downturn to last for a little bit longer. The good news, though, is we're seeing that the transaction volume in the secondary market remained at a relatively high level. And basically what's happening here is that you have a lot of Chinese households who bought property during the booming years, maybe for savings, for investment purposes. Now they are selling those property on the market to those people who really need housing for a living, because anybody who buys a house today are unlikely to think this as a form of investment, given this prolonged decline in prices. So this market is in some ways still basically trying to adjust from the oversupply we saw during the booming years. And I hope this adjustment will be completed not in the far future, but for now we will need to just observe whether we see increase or decrease in secondary listings, whether prices will stabilize. Only if we see those things happening, then we can say that Chinese housing downturn has finally come to an end. From the policy front, the government has employed a larger fiscal deficit in 2025 than any time in the past decade or so. We are seeing them maintaining still quite high fiscal deficit, but given the situation is altogether improving somewhat towards the challenging times in the past few years, they may not want to increase deficit even further, because by any means, a 9% of GDP fiscal deficit on the annual term is not a small number. So I think maintaining this kind of large fiscal deficit and try to shift the spending, for example, towards services sector, and also the government is saying that they want to invest more in larger infrastructure, energy projects that are important for the next 5-year plan. So these are the areas they could increase spending and continue to support domestic demand in a way that is still kind of the weaker side of Chinese economy. For the monetary policy, I tend to think that the PBOC will keep interest rate at today's low level. I think Chinese interest rates are lower than Europe, than US and most of the major economies. They do have a challenge here, which is the net interest margin of Chinese banks has also declined to a historical low level of only 1.4% or so as of the last quarter of last year. You see that whenever they cut the policy rate, it will bring a further drop of the bank net profit margin. So I think preserving that profit margin for banks has become a kind of consideration for the central bank. So I think they probably will hold the interest rate at this level. The bar for them to cutting rate further will be a bit higher than in the past, considering that this is already low, but also considering that inflation has been improving in the past 12 months. Now, for the external sector, definitely it has been a big contributor to China's growth. Our view is that we will probably see kind of a sustained level of trade surplus and current account surplus as a percent of GDP. I think the competitiveness of Chinese products remains very strong. And now that the trade frictions, trade tensions with the US has stabilized, it probably will support kind of a more stable environment for Chinese exporters. So I think we probably won't see a decline of China's current surplus over the next 1 or 2 years. But the scope for it to also go up further is also becoming very limited, considering that it's already at a very large high base. And on the back of this, what will happen is, I think, as the trade surplus is sustained at a high level, we will start to see the renminbi exchange rate to appreciate. Over the past year, the renminbi has appreciated about 5% against the US dollar. We probably will see a similar scale of appreciation of the renminbi for this year. And in fact, over the past 3 months, we're seeing a kind of stable pattern of renminbi appreciating on a gradual basis. Will it appreciate much faster than this? That's possible, depending on how the global economic situation changes on people's expectation. And critically, I think one thing, it depends on what will Chinese companies do with the large amount of foreign exchange holdings they have holding outside China. Basically, over the past 3 years, when renminbi was under depreciation pressure, Chinese corporates, they decided that it's probably in their interest not to convert their export proceeds into renminbi, but parking them as, for example, US dollar deposit outside China. So that will give them higher yield, and also it will help them avoid the loss from the exchange rate depreciation. Now the currency is strengthening against the dollar. The thinking among corporates is starting to change, but how quickly they withdraw those money back to onshore will determine the path of how quickly we see renminbi appreciate. For now, my kind of forecast is we maybe see renminbi going up to 6.7 against the dollar by end of this year. Then with that renminbi strengthening, I think we're also entering into a period that the assets priced in renminbi, assets related to China, is becoming more attractive to global investors compared to the situation in the past few years. So I think this is probably the time where we'll start to see more progress being made in terms of renminbi's position as a reserve currency, in terms of the use of renminbi internationally. And I would also highlight that this has been put as one of the top priorities for the government in the 15th year plan. So I expect to see progress both on policy front and also basically on how the global other countries, companies, financial markets in terms of their exposure to the renminbi related assets. With that, let me stop here and pass on the floor back to Peter.
Yeah, thank you very much, Dr. Yi, for your interesting statement. For the questions we come in a second, I hand now over to Dr. Haes. Dr. Haes is the Managing Director of the China Institute, Deutsche Wirtschaft, and she holds a PhD from St. Gallen University and a master for LMU Munich. So, Julia, the floor is yours. Please go ahead.
Thank you. So I will share my presentation as well. Can you see it? Good. Well, thank you so much for having me, and thanks that we have the opportunity now in the second year to discuss the Chinese and the European perspective. And Dr. E already covered some of the aspects that I also want to cover, but maybe I can contribute a little bit different perspective. So there are some challenges in the Chinese economy, and I quickly want to run through those challenges with you, and then I want to turn the view back to Europe and discuss what how German companies can react to this. So as we already heard, the real estate sector is still in a decline now in its 5th year. And it's quite difficult, despite the measures of the government, to recover. Measures included both the real estate developers, but also the buyers. There were some easings on buying restrictions due to residential residency, but also cutting down down payment ratios, providing cheap loans, but still it did not quite work in the expected way. And we think that it will probably take at least 5 to 10 years to recover. And of course, the property sector had such a big contribution to the GDP that is very difficult to replace by other sectors. So there's still a lot of pressure on the real estate sector. We see an upturn in infrastructure development. I travel to China regularly, and I always try to see what's going on. And in the last on our last trip, I saw so much railway construction that was really amazing. So this kind of infrastructure is being built up, but of course, it cannot replace the whole property sector. The second big issue is the persistently weak consumption. Xiong mentioned it already. It's still weak. It's weak due to little confidence in the economic recovery, but also in personal negative job expectations. The trade-in programs of last year were successful, and they stabilized consumptions in food and household products. But it's very difficult to maintain this, and probably there will be a decrease of the economic impact for 2026. And the investments are also low for the same reason. Households don't buy apartments, at least not in large scale, and private companies are very hesitant to make investments in their companies, also due to low expectations for economic development. Services are doing a bit better. We already heard this as well. The government is actively promoting services, but like you already mentioned, the last 20 years were really mostly characterized by industry boosting economic policy and not so much services. So there's a lot to catch up. And again, it's a little bit difficult to determine where this is going or how fast it's growing. Both because the government does not have infinite money to spend on developing the services, but also consumption is still weak and people are still keeping their pockets tightly closed. And so although we see that there's more consumer spending on leisure activities, it's still, of course, it's not replacing the real estate sector. We also heard about deflationary pressures. The prices declined due to property downturn, overcapacities, and weak market expectations. The consumer price index stayed about the same. My interpretation is that this has mostly to do also with the trade-in programs, and it's not really an increase in consumption, or at least not a big increase, and it's still difficult to maintain. The producer price index fell. That, of course, indicates the fierce competition among companies. We heard that there's so many more new companies entering different industries. So that's there's a lot of pressure, and probably many of those companies won't survive in the long term. So there will be a concentration on bigger players. And so what is necessary to to stabilize the economy, well, it would require a very fast restructuring of the government debts, especially local government debt. The government is working on this, and we've seen that the stimulation measures, there's a difficult balance to maintain between there cannot be too many measures, but they still have to be at the right level. So that's quite difficult to find the sweet spot there. Then, of course, as I mentioned, local government debt is a big problem. They have been hit hard by the property crisis, and they often have to shoulder a lot of the support measures, such as, for example, measures for young families. So they are really very tight in money. The total debt of the government or of the state end of 2024 is estimated at $13 trillion US. And there was another 4% budget deficit added last year, and Beijing has signaled that it will stay, or that it will keep up these higher budget deficit ratios in order to stimulate the economy, as you already mentioned as well. So there's again a lot of pressure. And the reforms of local government debt restructuring are underway, but that's quite difficult to do on such a high level or high scale. And also the local governments are still in competition for fiscal subsidiaries or subsidies. And so there's still a very strong competition, which again fuels the overcapacities. Then we have a structural imbalance in the labor market. The official unemployment rate stayed about the same, but unofficial reportings say that the unemployment rate is probably higher. Many young people are looking for stable jobs again, so they enter the National Civil Service exam. There has been an increase of participants by 236% in the last 5 years. So that's quite an increase. People are looking for more stable jobs. Flexible employment, such as food delivery drivers, ride-hailing, live streaming, etc., is also on the rise, but the perspectives are unclear. The job situation is mostly quite unstable, and we don't know how the long-term development will be. Just think about autonomous driving, which will have a huge impact on, let's say, ride-hailing. And jobs in traditional labor-intensive industries, such as manufacturing and real estate-related sectors, are declining. The companies that do make investments are investing in AI, which is replacing jobs. And the low demand in general is also lowering production. So the number of jobs is also decreasing. And then, of course, we have the large trade surpluses. You already mentioned it. In the last year, it was a record high. The main countries that China exported to were ASEAN, the EU, India, Africa, Latin America. Of course, the exports into the US decreased. That was to be expected. And the top exports are semiconductors, ships, and automobiles. And the top import countries are Indonesia, Singapore, India, and the Netherlands. The Netherlands, of course, mostly with products in automated data processing equipment and semiconductors. And for Germany, China is still the largest import partner with a plus of 7.2% last year. Exports to China, from a German perspective, decreased by 10%. So while China is still a very important partner, the German companies are having their problems with exporting to China. So what are the implications? Well, we see that the Chinese government has a very strong political incentive to stabilize or to even increase GDP growth, probably just stabilize. I think they will be happy with that. The domestic demand remains structurally weak, and it proves difficult to revive. So exports will still play a crucial role in maintaining this GDP growth. And we have to be prepared that more Chinese companies will try to go international. But Beijing also is aware of the concerns of the other countries and of potential pushbacks. So they are working hard on encouraging higher imports and encouraging economic cooperation in third markets. They do see that there's a big potential. And on my next slide, I also want to mention that German companies see the same potential to cooperate with Chinese companies in third markets. This is my last point on the slide, but nevertheless, so this is a chance for German companies, especially for the ones that are already in China. They see an opportunity there. And this is probably also a good idea for some German companies that are not yet on the Chinese market to seek cooperation. But let's back up. We see a renewed diplomatic engagement. Several Western leaders have visited China in the last months, such as Canada, the UK, and France. And the German Chancellor is also planning a visit to China in late February. So we see that countries are trying to revive and to improve relations with China, especially in light of what's happening on the other side. It's more difficult to predict what will happen with relations with the US. So countries are looking to balance these relations a little bit. The European Union is still maintaining its Buy European agenda, which basically promotes European companies, and this means that for Chinese firms, the environment is getting more competitive, and there's also more regulatory pressure. On the Chinese market, German companies are still investing in the Chinese market. They are still putting a lot of emphasis on the Chinese market. They do this because they want to maintain global competitiveness. Still, China is a very cost-efficient production location. They also want to participate in innovation and monitor competitors. And as I said before, they also want to develop partnerships, both for the Chinese, but also for international markets. The German companies increased their investment in China to around 7 billion in 2025, which is a huge increase from 2024. And they also plan to continue their engagement. The German Chamber of Commerce, or the International Chamber of Commerce, has its yearly business confidence survey. And in the last survey, 2025-26, 93% of the surveyed companies intended to remain active, and 53% even plan to increase their investment in China. So China is still very important, although a little bit challenging, but maybe that's also what German companies need, because competition in Germany by Chinese companies will also be intensifying. And so German companies need to be on their toes. Chinese companies have a culture that questions the traditional ways of doing business, especially for German companies. So they don't always follow the written and unwritten business conventions, challenging the German business model. So I think what's really necessary for German companies is they have to reassess their business models. They have to find new ways to present and innovate their products, services, and processes. And like I said, on third markets, there's opportunities to also work together. So these are just two quick slides about the CIDW. I think I will skip those because I want to leave enough time for our discussion, and I look forward to your questions. Thank you.